You have a number, a three-digit number that follows you everywhere. When you apply for an apartment, a car loan, a credit card, even some jobs. And you probably don't know exactly what it is, how it got there, or why it changes. But banks, landlords, and insurance companies, they know your number, and they're making decisions about your life because of it. Your credit score is one of the most powerful numbers in your financial life. And the system that creates it? It's weirder than you think. Let's break it down. A credit score is a three-digit number, usually between 300 and 850. That's supposed to predict how likely you are to repay borrowed money. That's it. It's a prediction. A bet on your future behavior based on your past behavior. Most people have heard of FICO scores. That's the model created by the Fair Isaac Corporation back in 1989. About 90% of top lenders in the US use some version of FICO. But there's also Vantage Score, created in 2006 by the three major credit bureaus, Experian, Equifax, and TransUnion. Here's the thing nobody tells you. You don't have one credit score, you have dozens. A FICO alone has over 50 different scoring models. The score your credit card app shows you might not be the same one a mortgage lender pulls. It's like being graded on the same test by different teachers who each have their own rubric. So what actually goes into your credit score? FICO breaks it down into 5 categories, and the weightings aren't equal. The biggest factor, 35% of your score, is payment history. Do you pay your bills on time? Every time? One missed payment can tank your score by 50 to 100 points, and it stays on your report for 7 years. 7 years. You could be a perfect borrower for a decade, miss one payment during a rough month, and carry that mark for the better part of the next decade. The second biggest factor is how much you owe. Specifically, your credit utilization ratio. That's 30% of your score. If you have a credit card with a $10,000 limit and you're carrying a $3,000 balance, your utilization is 30%. Here's where it gets counterintuitive. Having zero debt doesn't give you a perfect score. The system actually wants to see you using credit, just not too much of it. It's like a test where you get marked down for leaving the page blank. You have to play the game to win it. The third factor is length of credit history, 15%. How long have your accounts been open? The longer, the better. This is why financial advisors tell you never to close your oldest credit card, even if you don't use it. Fourth is credit mix, 10%. The system likes to see that you can handle different types of debt. Credit cards, auto loans, a mortgage, student loans, having a variety tells the algorithm you're experienced with managing money. And fifth, new credit inquiries, also 10%. Every time you apply for credit, the lender does a hard pull on your report. Too many hard inquiries in a short period looks desperate, like you're scrambling for money. But here's a quirk. If you're rate shopping for a mortgage or auto loan, multiple inquiries within a 14 to 45-day window count as a single inquiry. The system knows you're comparison shopping, and it gives you a pass. Now let's talk about who's actually keeping track of all this. 3 companies, Experian, Equifax, and TransUnion. These are private for-profit corporations. They're not government agencies. They're data companies, and their product is you. They collect information from lenders, credit card companies, landlords, and other sources. They compile it into your credit report. Then they sell access to that report to anyone with a permissible purpose: banks, insurers, employers, and landlords. You are the product being bought and sold. And here's the unsettling part. They make mistakes. A lot. A 2012 study by the Federal Trade Commission found that 1 in 4 consumers had errors on their credit reports that could affect their scores. 1 in 4. That's tens of millions of people walking around with inaccurate financial identities. Some errors are minor. A misspelled name, a wrong address. Others are catastrophic. Accounts that aren't yours. Debts you already paid showing as outstanding. Or worst of all, someone else's entire financial history mixed into your file. It's called a mixed file, and it can destroy your score overnight through no fault of your own. Your credit score doesn't just determine whether you get a loan. It determines what interest rate you pay. And that difference is enormous. Let's say you're buying a house, a $350,000 mortgage over 30 years. With an excellent credit score, say 760 or above, you might get a rate around 6.5%. Your monthly payment, about $2,212. Over the life of the loan, you'd pay roughly $446,000 in interest. Now say your score is 620. Same house. Your rate jumps to 8%. Over 30 years, you'd pay about $574,000 in interest. That's $128,000 more for the same house, just because of a three-digit number. It doesn't stop there. Your credit score affects your car insurance premiums in most states. Some employers check credit reports during hiring. Landlords use them to screen tenants. Your cell phone carrier might charge you a deposit. Even utility companies can require one. The score was designed to measure creditworthiness, but it's become a proxy for trustworthiness, reliability, and character, which it was never built to measure. Here's the fundamental paradox of credit scores. You need credit to build credit, but you can't get credit without credit. It's a chicken and egg problem that disproportionately affects young people, immigrants, and anyone who's tried to live debt-free. About 26 million Americans are credit invisible. They have no credit history with any of the three bureaus. Another 19 million are unscorable. That's 45 million adults in the US who essentially don't exist in the credit system. If you've never borrowed money, if you've paid cash for everything your whole life, the credit system doesn't reward you. It ignores you. A person with zero debt and $1 million in savings can have a worse credit score than someone carrying $10,000 in credit card debt who makes minimum payments on time. The system doesn't measure wealth. It measures participation. Credit scoring didn't always work this way. Before FICO, lending decisions were based on personal relationships and, let's be honest, a lot of discrimination. A banker would look at you, decide if you seemed trustworthy, and make a judgment call. The Fair Isaac Corporation introduced its scoring model to remove that human bias. And in some ways, it worked. A number doesn't care what you look like, but it created new forms of bias. The algorithm reflects the data it's fed, and that data comes from a financial system that has historically excluded entire communities. In the 1970s, the Equal Credit Opportunity Act made it illegal to discriminate based on race, sex, or national origin. The Fair Credit Reporting Act gave consumers the right to see their own reports and dispute errors. These were important steps. But the underlying architecture hasn't fundamentally changed. The credit system creates perverse incentives. Want to improve your score? Open more credit accounts. Carry small balances. Make minimum payments. The system is essentially training you to be a profitable customer for banks. The ideal credit score customer, from a bank's perspective, isn't someone who pays off their balance every month. Those people, called deadbeats, in industry jargon, believe it or not, generate no interest revenue. The ideal customer carries a balance and generates a steady stream of interest income. Credit card companies send pre-approved offers to people in specific score ranges, not too high, not too low. They want the sweet spot. People who will use the card, carry balances, and pay just enough to stay current. The entire marketing machine is optimized around keeping you in debt just enough to be profitable. So what can you do about all this? Pay everything on time. Set up auto-pay if you have to. One missed payment does more damage than almost anything else, and the only cure is time. Keep your credit utilization low. Under 30% is good, under 10% is better. If you're about to apply for a loan, pay down your balances first. Some people even make payments twice a month to keep the reported balance low. Don't close old accounts. The age of your credit history matters. Let that old card sit in a drawer. Just make sure it doesn't have an annual fee that's eating you alive. Check your credit reports regularly. You're entitled to free reports from all three bureaus at annualcreditreport.com. Dispute anything that's wrong. It's tedious, but errors are common enough that it's worth the effort. Let's recap. Your credit score is a three-digit number between 300 and 850. Payment history is 35%. How much you owe is 30%. Length of history is 15. Credit mix is 10. New inquiries are 10. 3 private companies compile your data and sell it. Errors affect 1 in 4 reports. A 140-point difference in your score can cost you $128,000 on a single mortgage. And 45 million Americans don't have a score at all. The system wasn't built for you. It was built to help lenders decide if you're worth the risk. And somewhere along the way, it became the gatekeeper to apartments, cars, jobs, and financial opportunity. You can play the game, and you should, because the consequences of opting out are real. But don't confuse playing the game with the game being fair. If this made you rethink that magic number, hit subscribe. We break down systems like this every week. And maybe check your credit report tonight. 1 in 4 people have errors. You might be one of them.